Financial Management, Unpacking the Income Statement. Welcome back behind my screen. And what we did last time is we looked at the overall scenario of how the income statement and the balance sheet link together and how the retained earnings comes across and rebalances the balance sheet. Today we're going to focus more on the income statement itself. So we're going to unpack it bit by bit so that you can see how it starts with the revenue and how it lands up at the end with your net income. And we're going to show you how it goes from the top and flows all the way to the bottom, from a big turnover to a smaller net income, and we'll show you what those elements are. But before we get there, let me just explain the whole accounting reporting structure. We start off with what we call business transaction documents. These are invoices, good delivery notes. These are things that show that a transaction has actually occurred, because you can't record it until it's actually happened. We take these transactions and we record them in the books of prime entry. This is where we do your journal entries. And a journal entry is just where you debit something and you credit something else. All that means is you add it to the one thing and you take it away from the other thing. The big concept within accounting is what we call the double entry bookkeeping system. Every transaction has two sides. So you debit something and you credit something else. For this course particularly, we're not going to get into debits and credits. That's like getting into the mechanics of something. That's like trying to understand how the engine of your car works when all you're trying to do is drive the car. So we're teaching you how to drive the car, not become the mechanic. But now they take the books of prime entry, and then we register it in the general ledger. And the general ledger puts it into the different categories. And then we link it to a trial balance, and the trial balance is to see that it does balance, and we move some of it to the income statement and some of it to the balance sheet. And you should understand that by now from the previous video. What do we put into the income statement? Well, anything that's an income or an expense goes to the income statement. Anything that's an asset or liability goes to the balance sheet. And then we take that and we create the cash flow statement from that, just to see what is cash, because some transactions are not cash transactions. So you can make a sale, but it might not be cash yet. And then we analyze this whole thing using ratios, and that will go through at a later stage, the different ratios, and that's unpacking it to see what's one thing divided by another, just to see what the implications are. And then we use that analysis to look forward and start forecasting something for the business. So that's kind of the overview of it. But let's get into the nuts and the bolts of the income statement. So the income statement is intended to show the sales, the costs, and the profit made over a period of time. And therefore it's got the words always for the period, or from one date to another date. Your income statement shows you a flow over time. On the other hand, your balance sheet will always be the balance as at or on a particular date. But your income statement is, what did we make over the last week, month, year? So here's an illustration of an income statement. For the year ended, it's still the end of the year. And then these numbers are in thousands of rands, and you can see you've got your revenue less your cost of sales gives you gross profit, less your operating expenses. That operating expense of a 946 is made up of all those other expenses taken together and added up. Then you land up with what we call the operating profit, less interest. You have your earnings before tax. You take off your tax and you're left with your earnings after tax. That's what we term the bottom line. When people talk about the bottom line, your earnings after tax. I just want to go back briefly to that cost of sales. This over here. The cost of sales in a stock environment, just so that you understand, is made up of opening stock plus purchases minus your closing stock. It means we came into the business with some stock that we wanted to sell. We're buying some more, and then what we didn't sell, when you subtract your closing stock, that's your cost of sales number. And you can see when we look at this income statement that we're starting at 7,400, but we only land up with 1,100 in round numbers. And a very important thing about this is that a lot of people, when you ask them how they're doing, they say, "Ah, fantastic, my turnover is 7,000." But that's the top line. What you leave with is only the bottom line. And there's a saying in finance, they say turnover is vanity. If you ask somebody about their business and all they talk about is the turnover, the top line, that's vanity, that's showing off. Profit is sanity. That's where you're looking at the profit. But cash is reality. And we say cash is reality because you can still have this profit over here of 1,166 and still go bankrupt if that money, if that cash is not in your pocket. So the cash flow is like the air that you need to breathe. And you can have big muscles, but if you don't get air, you can die. And the same with a business. And here you've got your income statement. And let's unpack this in a little bit more detail. So if we look at what we've just discussed, and I look at it as a picture, this is exactly what it is. Here you've got your sales, this big amount over here, but you've got to take off your cost of sales. You're left with your gross profit. Then you take off your expenses, you're left with your operating profit. You take off your interest, you're left with net profit before tax. Then you take off your tax, etc., etc. And you can see how that yellow portion becomes smaller and smaller. And that's what you're left with at the end of the day. Your net profit after tax, and then you can decide how much you want to give to shareholders and how much you want to retain in the business. And a question I often get is, why would we do this? Why would you have all these subtotals? Why don't we just say sales, net profit? Why have all these other yellow pieces in between? Surely that complicates it. And the answer is no, it doesn't complicate it. It actually explains it. We have these subtotals for analysis purposes so that we can analyze it and see what's in each slice as we go ahead. You know, if you got an apple and you think there's a worm in the apple, well, you'll cut it in half and you'll see, is it in this half or this half? And you might still not see it. So then you cut it thinner and thinner and thinner, and the more thinner each slice is, the more that you can see that is in each of those slices. And that's why we do it, for analysis purposes. By the way, a few years ago I heard a story. What's worse than finding a worm in your apple? And the answer is half a worm. Not two worms, half a worm. Because if you find half a worm in your apple, you are no longer a vegetarian. Anyway, so here we go back to your income statement, and here's another picture of it. So let's say you get this bottle of wine, and that's your sales, and you want to go drink this wine. But before you can drink it, you got to pour it into this funnel. And unfortunately, the funnel has holes in it. And as you pour it, the wine leaks out. And part of the leakage is your cost of sales, the cost of the product in order to get those sales. Then you've got expenses, other costs that you have to incur to get those sales. And then you've got to pay taxes. And then you land up with your profit. And your profit isn't the whole bottle of wine. Your profit is just this little drop over here. And this is kind of what explains the income statement, where you start off with a whole big bottle of wine and you land up with a little bit of profit at the end. So your income statement starts off with your sales. And then you take off your cost of sales and you're left with your gross profit. And you take off your expenses and you're left with your profit before interest and tax. And you take off your interest and you're left with profit before tax. And you take off your tax and you're left with profit after tax. And then if you pay dividends, that little bit is what you're left with, your retained earnings. So always think of this like a funnel that gets smaller and smaller and smaller as you get along. And now you've got your first exercise, your first opportunity to create an income statement. So what we've given you, and it's in one of the downloads, is a blank income statement like this. And I would like you to take the information I'm going to give you now and to plug the numbers into this income statement. It'll give you the opportunity to create your first income statement. And here are those numbers. And what I'd like you to do is, if you haven't done it already, download that exercise and then fill in these numbers. So please stop the video now and take these numbers, plug it in, and when you're finished with that, resume this video. So you can stop the video now. Welcome back. So hopefully you've done this little exercise and you might have struggled a little bit with it, but let's talk you through it. So you took these numbers and you plugged it into the income statement, and if you plugged it into the income statement, you would see that you would have your sales of 850, your cost of sales of 340, which is made up of your opening stock plus your purchases less your closing stock. And as you can see, we take the amounts on the left over here and we add it up to the cost of sales, and then you take your 850 minus the 340 gives you 510. That's your gross profit, less your expenses of 169, which is made up of all those numbers underneath it. And if you work down, 510 minus 169 gives you the 340, minus the 32 gives you the 308, minus the 92 gives you 215,740. So this is how we're showing that it goes from the big amount at the top to the small amount at the bottom. And then you can see that column that says percentages. And you kind of ask, well, what is that? What are those percentages? And all we're doing there is we're taking everything as a percentage of your sales. So your first one would be 850 divided by 850, and that would give you 100%. Then it would be 340 divided by 850, and that would give you 40%. And then 510 divided by 850, and that would give you 60%. And if we do this, you would land up with this. And then I often have students who stop me over here and say, hang on a second, if we start off with 100 and we're allocating 40 and then 60, we've allocated the full 100%. So what's the rest of it? And it doesn't work like that. The way it works is this is showing you it's 100 minus 40 gives you 60. Then we take 60 minus 20 gives you 40, minus 4 gives you 36, minus 11 gives you 25. And this is showing you how you start off with 100% of something and it becomes 25%. It's like that diagram where I showed you those yellow bars. You start off with this big amount and you'll end up with this little amount. That is what this is showing you. And this is what's called vertical analysis. Quite a fancy name, but really simple. You just take everything as a percentage of sales and you've now got your vertical analysis. By the way, you can do vertical analysis within a category. So I could do vertical analysis if I take, for example, my expenses. I could take each expense as a percentage of my total expense and do that same type of calculation. Just find the percent of how much each of these is contributing to the total. And that's what we're doing over here, vertical analysis. Well, if you've got vertical analysis, what other analysis do you think there is? Yes, and the answer is obviously horizontal analysis. Horizontal analysis is comparing now, instead of upward, it's side by side. So it's taking 1 year comparing to the next year. So if I had my sales for 1 year and my sales for the next year, I could see how much those sales have changed only looking at sales, but now from one period or 1 year to the next. And this is how we start understanding and analyzing if you've got budgets, even if it's not an income statement thing. So over here, we're looking at vertical and horizontal analysis. And what I've got here is my actuals. I've got my budget, what I thought it was going to be. And then I've got the variance. All the variance is the difference between the two. And the variance is the variance in amount and then percentage wise. And you take the difference between the two divided by where you started from, and where we started from was the budget. And so here, this is a combination of vertical and horizontal analysis, just an illustration of this. So there's another exercise, And what I would like you to do is download that exercise. Just quickly do it, and then we're going to discuss it. These are the numbers that you would have looked at and hopefully you've filled in. And what this is showing us, if we start analyzing it, if you have a look and I ask you, which year did you make more money? And you'd have a look and you look at net income and you'd see, well, net income for this year was 192. Net income for last year was 189. So we made more money this year than last year. And the interesting thing about this is if you showed it to an accountant, they might not be happy. And you kind of say, well, why? So let's first do the vertical analysis. And if we analyze this vertically, you can see that this year, our net income as a percentage of our net sales was 10%, or just over 10%. And our income as a percentage of net sales was 11% for last year. So hang on a second, we made more money, but our percentage was less. We made more money, but we should have made even more money. We made more money, but we were less efficient. And so this is what your vertical analysis can start showing you. Let's have a look at a horizontal analysis. Let's see if it reveals anything more. And if we look at the horizontal analysis, we're now trying to see where in this, which categories contributed to this drop. And our horizontal analysis show us that our gross sales went up by 9.69% and our goods returned was minus 50. Now one might look at a minus number and get negative about it, but not every negative number is negative. In this case, goods returned minus 50% means that people brought 50% less back, which is a positive thing. So overall our sales actually went up by over 10%, which sounds pretty good. So that's looking at the top line. Looking at the bottom line, the net income, it only went up by 1.5%. It's like filling a bucket of water with 10 liters. And when you get to your destination, you've only got 1.5 liters left. It's spilt out somewhere. There's a hole somewhere. Where is that hole? And if we have a look at this, we can see potentially that this hole is, you look at the percentage change and see where's the biggest one. And your biggest one here is 88%. Utilities. And you go, that's your problem. But an important thing is just to look at any other thing that has a percentage that is greater than your sales. And if we look, you can see your cost of sales is 14%. This is where percentages might be a little bit misleading, because this is an 88% change, but it's a smaller amount. It's 15,000 compared to the 14.5% change on 152. So percentages can be misleading because it depends on the base. You can have a big change on a low base. And this is what the utilities is showing us. So yes, it's a big percentage, but it's only 15,000. Your cost of sales is a smaller percentage, but it's 152,000, but it's still bigger than your sales, so it's a problem. So even if I have no idea what this business does, I can see that its problems lie a little bit with utilities, but it's off a low base, but it definitely lies with your cost of sales. So this is an amazing way of looking at this. Now I know where the problems lie within this company. I know it's within cost of sales. Did we change suppliers? Did they change their prices? Does it have to do with exchange rates? Does it have to do with anything around the cost of sales? The purchasing, did we purchase differently? And now I can go and investigate that to see how I can improve this. So part of the analysis, and this is simple vertical horizontal analysis, allows you to see where you need to go and investigate. I don't have to go and investigate the wages or the rent. That hasn't got a major impact. I know where the major impact lies. So this is your first little bit of information around the income statement, and we've unpacked that income statement for you that you have a better understanding of it. What we're going to do next is the same thing, but for the balance sheet. And we're going to unpack the balance sheet bit by bit. I'll see you in the next video behind my screen.